Title: Navigating the Economic Seas, the Impact of Tax Reforms on Investment Decisions. Introduction. In the ever-evolving landscape of finance, economic policy changes wield a profound influence over investment decisions. Among the myriad policy levers, tax reforms stand out as a potent force, capable of reshaping the terrain for investors and businesses alike. Understanding how shifts in tax policy reverberate through the investment ecosystem requires a deep dive into the complex interplay of fiscal dynamics, market reactions, and strategic decision-making. Tax reforms unveiled. Tax reforms represent a recalibration of a nation's fiscal policies, encompassing changes to tax rates, deductions, credits, and overall tax structures. Governments deploy these reforms as instruments to stimulate economic growth, address fiscal challenges, or achieve broader socio-economic objectives. The impact of tax reforms on investment decisions extends beyond mere numbers, delving into the intricate dance between policy adjustments and the behavior of investors and businesses. Corporate decision-making in the face of tax changes. One of the primary channels through which tax reforms influence investment decisions is the corporate realm. Changes in corporate tax rates, for instance, can significantly alter the after-tax profitability of businesses, prompting strategic recalibrations. Consider a scenario where a government lowers corporate tax rates to incentivize businesses and stimulate economic activity. In response, companies may reevaluate their investment strategies, contemplating increased capital expenditures, expansion initiatives, or research and development projects as they seek to leverage the improved fiscal landscape. Conversely, if tax rates rise, corporations may adopt a more conservative stance, scaling back expansion plans, trimming discretionary spending, and prioritizing cost-cutting measures to maintain profitability amid higher tax burdens. The strategic decisions made by businesses in the wake of tax reforms ripple through the economy, influencing job creation, innovation, and overall economic vitality. Impact on investor behavior. Investors, attuned to the nuances of tax policy, recalibrate their portfolios in response to changes in the fiscal landscape. Dividend-oriented investors, for example, closely monitor tax rates on dividend income. A reduction in dividend tax rates can make dividend-paying stocks more attractive, potentially leading investors to reallocate their portfolios to capitalize on the favorable tax treatment of dividends. Furthermore, changes in capital gains tax rates can prompt shifts in investment strategies. Investors may be incentivized to hold onto investments for longer periods to benefit from lower long-term capital gains tax rates. Conversely, in anticipation of higher tax rates on short-term capital gains, investors may adjust their portfolios to favor long-term investment horizons. Real estate dynamics and tax reforms. The real estate sector, sensitive to tax implications, experiences unique dynamics in the wake of tax reforms. Changes in property tax rates, mortgage interest deductions, and capital gains taxes on real estate transactions can significantly alter the calculus for real estate investors. For instance, a reduction in capital gains taxes on property sales may stimulate increased real estate transactions, driving demand and influencing property values. Moreover, alterations to mortgage interest deduction policies can impact the attractiveness of real estate as an investment. If the government reduces or eliminates these deductions, the cost of financing real estate purchases may rise, potentially dampening demand and impacting property values. Investors in real estate must carefully assess the tax implications of their investments, factoring in policy changes that can shape the overall landscape. International investment flows and tax policies. Tax reforms also reverberate through the global economy, influencing international investment decisions. Variations in corporate tax rates among countries can incentivize multinational corporations to allocate resources strategically. For instance, a country lowering its corporate tax rates may attract foreign direct investment, leading companies to establish or expand operations in that jurisdiction. Conversely, if a country implements tax policies perceived as unfavorable, businesses may reconsider their international footprint, potentially divesting from certain regions or redirecting investments to jurisdictions with more favorable tax environments. The intricate dance of global capital flows is intricately linked to the tax policies implemented by nations, making tax considerations a critical aspect of international investment strategies. The role of uncertainty in investor sentiment. Uncertainty surrounding potential tax reforms can also influence investor behavior. When governments signal intentions to overhaul tax policies, investors may adopt a wait-and-see approach, delaying investment decisions until the fiscal landscape becomes clearer. This uncertainty can introduce volatility into financial markets as investors grapple with the unknown and adjust their portfolios based on anticipated policy changes. The psychological aspect of investor sentiment is equally crucial. Positive perceptions of tax reforms that stimulate economic growth can buoy investor confidence, fostering a more optimistic outlook and potentially driving market rallies. Conversely, concerns about adverse tax changes may lead to heightened risk aversion, impacting market dynamics and influencing investment decisions. Conclusion. In the complex and interconnected world of finance, tax reforms emerge as a formidable force shaping investment decisions. From corporate boardrooms to individual portfolios, the impact of fiscal policy changes extends far beyond the realm of taxation, influencing economic activity, market dynamics, and investor behavior. As governments navigate the delicate balance between revenue needs and economic incentives, investors must remain vigilant, adeptly adjusting their strategies to harness opportunities and mitigate risks in the ever-evolving landscape of tax policy and its implications on the world of investments.